Welcome to the PI World Thursday webinar on the 11th of June 2020. I'm your host, Tamsin Freeman. Today I'm delighted to be joined by Robin Griffiths, who's described as one of the world's most experienced and highly regarded market analysts, who's going to comment on the macro picture. Robin, thanks so much for joining us. Tell us a bit about your background.
Well, I joined the City of London in 1966. I'd come from university where I got a degree in economics, and it was the degree that led me into Phillips and Drew at the time. And they trained me to be a stockbroker. In the end, I became a member of the stock exchange in my own right. Years later, I joined W.I. Carr, who was the first firm of brokers to have an office in Hong Kong, number two to be British, but in Tokyo. And then later, some of that firm was taken over by Griffiths and Grant. And Griffiths and Grant actually sent me to live in Tokyo. And I spent probably 10 years of my life going backwards and forwards to Tokyo when that market was on the way up. That market peaked in 1989, of course. So after that, I came back to England. And then James Capel hired me when they were ranked number one in the surveys with different type of analysts. And I was ranked number one as a technical analyst. So they hired me. The firm was already owned by HSBC, and I basically stayed with HSBC until their compulsory retirement age. But when I retired, I got bored with retiring very quickly, and then went to Rathbones, who'd been a client for a long time. And when I had got to their retirement age, I went to Cazenove, who knew how old I was but didn't care. So I went to them. And I finally left them to sail my own yacht the whole way around the world. And in order to do that, I had to stand down. And I'd done that. And again, still didn't want to retire. So write a new newsletter, which is what I'm currently doing now.
And you're trained in technical analysis, aren't you?
Yes, I was ranked number one in the country as the technical analyst for a long time, and with a global coverage. The documents I published at HSBC had global coverage, and of course HSBC was itself a global bank. So many people know me from there. Many institutional clients know me from there. The current newsletter still has institutional readers, but it's also read by high net worth individuals.
And that covers off economic cycles, doesn't it?
It's a sort of, it's a development of what I always used to do at HSBC. Basically what I noticed was that when people make money on the stock market, they don't really care whether it pays a good dividend or what the earnings are. They simply want the share price to go up whilst they own it. And they don't want to own it if the share price is going down. So I became an expert on what is the trend of the share prices. And I noticed quite quickly that those trends moved in cycles, and the cycles referred back to the economic cycles, which I'd studied at university. So for a long time, I would draw a roadmap based on the economic cycles and the business cycle. And say, if this is correct, I can draw you a roadmap of where the stock market's going. And it worked pretty well. And I'm basically still doing that now.
So with the current markets, did the speed of the COVID crash and its recovery since surprise you? And where do you see the market headed from here?
The answer to where we're going, it's a bear market, and it's a very bad bear market. And the damage to the economy that drives that has already been done. And you can't wave a magic wand and make it disappear. So that the current rally that we've got, which is very violent, is in my work quite clearly a bear market rally. Now, when I look back through the history that I've lived through, and even bits of history that happened before my time, the nearest equivalent period to what we're going through, to which we will be similar, was 1929 going on into the depressionary period down to 1932 and 3. And indeed, when you overlay on what happened to the stock market in that historic period with where we are now, the violent fall that we've had was very equivalent to the crash of 29. And then what happened historically after that is the first rally was a 51% rally on the American index. Just to put that into context, what the rally has recently done is rally 45%. So we're actually slightly lagging behind with what we did back in the earlier days. And when the rally is over, and it may well be ending right now, the rest of the bear market is going to take us down. And we should get into our heads that the hit to the global economy is bad. It's so bad, we don't even need the word recession. The word in many economies will be depression. We're in a depression now.
And do you see us falling to a low that takes us back to 0.9 or a low that takes us back to 2000? How low do you think we're going to go?
We're going to take out the recent low, possibly by a lot. The only bit that we don't know in advance is what will governments do about this. What we think they're doing, because it's in our face, is they're printing free money, or very nearly free money, which of course didn't happen originally back in the old days. But the hit to the economy, the rate of unemployment is already in depressionary levels, even in relatively strong economies like the US or Britain. If we go around the world to weaker economies, I'm thinking Brazil or India or parts of Africa, that already is a depression right now. So I think we can say that the world economy is going into a depression. As governments print money to try and cushion the downside, what you basically are doing is devaluing your currency. At the moment, the US economy is valued at approximately $21 trillion. And already in this year, the Fed have printed a third of that entire figure and pumped it out into the market. That's their policy, to print money. So we're going to have very cheap money. We may even later get negative interest rates, which means that bonds and gilts in this country will be a buy, because they will preserve more of your money than owning equities whose prices are dramatically volatile.
But isn't there a danger of an asset bubble, that assets just get inflated and inflated because of all the money sloshing around?
Yeah, it is true that eventually, especially priced in dollars, where the printing press is running most, there will be some inflation. But at the moment, it's a question of when do you get inflation and when do you get deflation. At the moment, we are in a deflationary environment. And some of this is explained most clearly by a famous economist from America called Lacey Hunt. And he used to be at HSBC. And he's now managing a large bond fund. And he's saying that if you print a lot of money, but the money just sits there, as it were, in a bank and doesn't circulate violently through the economy, all of that money doesn't actually do what you intended it to do when it was printed. And this, in a nutshell, is happening. There is almost no circulation of the free money. So you've printed too many dollars, but the dollars aren't being used. So the economy is still in a depressionary condition. People are getting fired. The businesses are contracting. It's all deflation. Once we get to a super low, then getting rid of that money will lead to inflationary forces. Real assets will eventually come on up faster than money, and then we'd get inflation. So in terms of timing, we're in a deflationary environment now. But when we get to a final low, which in my work is not this year, is nearer 2023, then we can have an era of inflation after that.
And you don't think all this money sloshing around inflates the stock market, so we get an asset bubble of that nature?
I think that in a funny way, we've been having an era of inflation for the last several years. One of many people follow what Warren Buffett says, because he's a brilliant value investor. And basically, using many of the matrices that Warren uses, the US stock market and anything that's followed it hasn't been cheap in his terms for a long time. Many times when the markets had a dip down before, Buffett has been very quick off the mark to whip in and use his cash reserves to buy. So when he's being brave when others are being panicky. And many people think, well, that will follow him. Well, if you're following him, he did not buy the dip. He sold his airline companies into it. And his policy is to go into what we're looking at with the largest sum of cash you can get your hands on. And the amount of cash sitting in Berkshire Hathaway has gone up by more than 15 billion. He's definitely not wanting to spend at the moment. He wants to have a cushion so that when the real lows are around, he'll be able to buy.
And do you think the credit system will collapse with all the insecurity?
It's in a funny way been sort of slowly collapsing, and it began with Mr. Greenspan. Mr. Greenspan always knew. There's a man in England that I now long deceased who, as a young man, had an apartment very close to Greenspan. And Greenspan told him then, I think I can become chairman of the Fed. And if I do, I can head off a recession by providing lots of money when it's needed. And of course, he got the job and he started printing money. And if you like, on his watch, it didn't go wrong. And then Mr. Bernanke took over, and on his watch, it didn't go wrong. And at the moment, it hasn't gone wrong yet. But eventually, we've built up the debt bubble so that what used to be the safest asset on the planet, which would be US Treasuries, has now gone down to such low levels, it's almost become toxic waste, except that it's still a US Treasury, but it doesn't give you the return. And so if you misprice because you printed too much, what used to be the safest assets, that causes mispricing across the rest of the markets. And one of those mispricing is certain equities that the public fall in love with have gone up to crazy, crazy values. I mean, on the way up, Amazon or Tesla, there was plenty of times when Tesla never had any earnings. They were losing money, and yet the share price went up more than 100% a year. So, you know, it detached from historic logic of how we do investment. But everybody just says, I like Tesla, I like the cars, he's a genius, buy. And that drove the share price. In fact, some of those companies that are in the NASDAQ index, the Facebook, Amazon, Netflix, they're all in that sort of category. You can't argue that they're cheap. They're just very big, very famous high-tech stocks. And people are using them as almost gambling chips, effectively.
And do you think the Fed stimulus will see a devaluation of the dollar?
Yes, I do. But that's not going to happen very suddenly. If you look back through history, the dominant superpower of its era, its currency has always been very important. And then when a different economy overtakes it, the old currency doesn't disappear, but it just drops back into the matrix of other currencies, and the new dominant one takes it up. I mean, there was a period when I was in the city, when you needed to know what the guilder was. The guilder was a very important currency, and for historic reasons. And then, of course, there was an era when sterling was the dominant currency. Well, we still have sterling, but you can't just turn up in New Zealand, take out a Victorian sovereign, and people want it better than their own money. It doesn't work like that. And ever since 1946, the dollar has been the dominant currency. And it's gone back to President Nixon, who, back at that stage, America was importing a lot of oil from Saudi Arabia. Nixon sent Mr. Kissinger over to talk to the Saudis, saying, your oil's important, we're your biggest customer. We need to defend your oil. We'll use our American forces to do that. And so the petrodollar era began. And that's what we've still got. But I think we're ending that era right now. And to confirm that, the crash in the price of oil is very important. We're all going electric. We're all moving away from coal. We're moving away from oil onto other things. And in any event, America doesn't buy any oil from Saudi Arabia anymore. The biggest customer is China. And China and other nations saying, I don't want to go through the dollar when I do some trade with you. We can use our own currencies, can't we? And I think we're moving into an era, which will take a few years to get there, when the next dominant currency will come up to become the dominant one. And it sounds like it's China. But when you currently talk to Chinese people, they're saying at the moment it's a little early for the renminbi or the yuan to be the dominant currency. What we would be happy to go into is a period when we use a basket of currencies in which the basket, no one currency is super dominant. And furthermore, in that basket, we want to include gold. We want it to be linked back to gold, which is real money. And I think this is what we're moving into. Eventually down the road, I think that basket will be replaced. Well, the renminbi's become the biggest currency, but I think we're looking into the future for that to take place. So we're at a period when we're at or very near the supreme peak of the dollar. It's slowly losing clout and will eventually go back to being a big currency. And by big within the world basket, I think the dollar might be, say, 10% of the basket. So it will still be big. It'll be bigger than sterling, but we'll both be in the basket.
And where do you see gold headed?
On the ranking system that I do in my newsletter, gold is the top investment. I need to say that for the newsletter, we deliberately use medium to longer term trends. So if little fluctuations take place in the opposite direction, we tend not to, we point them out, but we don't trade them. So at this precise moment, in the very short term, there's short-term weakness in dollars, in gold. But that's going to set up the next buying opportunity. For somebody that already owns some gold, which includes myself, I'm not going to sell now. But when we get down to the end of the little setback, I'm going to buy some more. So longer term, gold is very strong. It's actually been going up in 26 different currencies for a long time. And now it's even going up in terms of US dollars as well. The next serious overhead resistance is the old all-time high. So between 1900 and 1950 is resistance. And once it breaks that, it's going to go a lot higher. And believe it or not, numbers like $7,000 an ounce are entirely predictable using the normal matrices that forecasters use. So owning some gold is clearly a very good way to be. And gold has been real money for thousands of years.
And where do you see it dropping back to? It's around 1,700 at the moment.
Yes, you could take $100 off there. I don't know that I can. What I can do is recognize when the drop back is complete and it's going back up again, and then come in on it, trying to predict the exact low in advance. I published a chart with where the likely levels are. It's rather like going down the stairwells in a very tall building. If you go lower than this level, well, it'll go to the next floor. Whether it goes down 2 floors or 3, we don't know yet. You follow it down. But there's a risk of $100. But on the upside, we're talking thousands of dollars. That's the balance. So I think I've got a quarter in gold-related investments, quarter of the portfolio.
So you're saying that we're looking at depressionary times, really, until 2023, yes. The end of. And yes. Then what do you see happening? And where do you see global growth coming from?
Right. Okay. Well, then there will be, it looks as though there will be a new growth period. And most growth periods are driven by the exploitation of a new technology. The expression that goes well with that was invented by Joseph Schumpeter, the man that did the economic cycles I've been referring to. And his expression was creative destruction. When a new technology comes in, it nearly always kills off an old technology. So if you used to travel by horse-drawn carriage, the motor car killed you off but created a different boom. The steam engine did the same thing. Electricity did the same thing. And we've seen lots of old industries, coal, steel, and things declining, but new industries coming in. The latest one is the handheld device or phone. I mean, it's brilliant, but it did it by killing the old-fashioned phone. So there basically are new technologies queuing in the wings. Some of them are things to do with like robots. More will be to do with artificial intelligences that will get into all sorts of devices. And there will be other technologies, which I can't off the top of my head name them all. But I think one of the things we can say is you used to have to wait about 20 to 50 years for the next big technology to come through. That's roughly how long it took between canals, steam trains, and all that. But now we've got technologies queuing in the wings. And the second part of the equation is there's a new demographic of people coming forward. And the demographic that will participate in the new bull market, we call them millennials. They were born roughly at the top of the millennium, so they're roughly 20 years old. Now we can count them, it's a big generation, but they're not yet senior enough in their jobs so that their mortgages and their consumption will drive the economy. But in a few years' time, they will be getting old enough, and it'll be there driving this economy and this new type of technology. And secondly, when we say, well, where are more of these people? You look at Asia. We are quite clearly moving away from the Western world dominating. We may have some brilliant designers, but the production and the growth of all these things will be Asian. And the man who has done brilliant work on this is called Ray Dalio. I thoroughly recommend people reading his books. He runs Bridgewater, and he's made himself over 18 billion. He's a good man to follow. He is talking about the ending of the era when first Britain and then America were dominating, and we're going back to a period when the powerful demographics of Asia become dominant. And quite clearly, the dominant one at the moment is China. But after that, you can quite clearly see that the Indian demographic will eventually overtake China, as indeed historically it's done before. If you add together all of the people that were racially Indian in what used to be called Bharat, ancient times, so they include Bangladeshis and Pakistanis, all of that, there are more of them now than there are Chinese. And of course, they started later, and at the moment they're going to struggle with the disease. But once they get through that, the sheer growth of that demographic, they're going to end up overtaking China and will eventually become the dominant economic body on the planet. And again, when you think of what leads these cultures, both in China and in India, liking gold is absolutely part of their psyche. It's right in them. Anyone, even in England, if around about the festival of Diwali, you could almost plot a rally in the price of gold as Indians buy some more gold for the Diwali ceremony. So we're looking to Asia, basically. So looking for where I'm going to put some money long term. My favorite market long term is India. Just at the moment, I don't own it because they're struggling with the disease. And when you see how close together you live in some of the parts of India, it's going to be a tough go. But the disease will pass, and then that powerful demographic will drive the long-term growth afterwards.
And are you talking 2030 for that powerful demographic to take hold?
I think for India, I think what will happen is well before 2030, China will overtake America. It's in many industries, it's done it. And sometime after 2030, but not a long way after that, India will be right up and in the mix and eventually will overtake. I mean, whether it's going to be 2030 or 2040, I don't know. But that sort of time period, it's going to be right up there, very big. And finally, when you come back to England, the Indians have been investing in England far more than we've invested in them, really, when you think of the businesses that they bought here. I mean, and historically, because of our empire days and all of that, there is a strong link for them to want to trade with us as a main partner, I think. So I've made very good money on the Indian stock market. I bought an exchange-traded fund on their index when it was around 14,000. I sold it when it was around 41,000. Now that it's dropping back because of the disease, somewhere soon, I'll be buying back in at around 25, 28,000 sort of thing. But the long-term trend is clearly upwards, powerfully upwards.
And presumably their demand is going to come domestically. The international trade is going to be less significant for them because they've got such a large population.
Yes, no, exactly right. And indeed, this to some extent has happened with China. Originally, China took over making everything because wages in China were very, very cheap. Now, of course, wages in China have come on up. And they're more interested in their own society and building trains and things for their own quality of life, so that you're spreading out into little places like Vietnam and others to get the right mixture. And the same will apply to India. But one of the things I think might be a bit different is India doesn't really aspire to become the manufacturing capital of the world. It's done it differently, whereas China always aspired to be that. So India is more into intellectual and service economy development, but they do have the stronger demographic. I think what we can say with world life statistics is peak baby on this planet has already peaked. We're well past peak baby. Even in the countries where you'd expect women to have, 5 children each, they don't. They're down to 2. They know that the babies won't die. They will live, so they don't need 5 more for the ones that die unnaturally. But of course, as we all live longer, the total world population will grow. It almost certainly will meet 10 billion, but it probably won't go miles quicker than that. So if we can figure out a way to feed 10 billion people, we're going to be all right. And of course, the answer to doing that is if you have to grow a crop to feed a cattle, to eat the cattle, it's very expensive on the planet to do that. But if you grow the crop for a human being to eat it, the planet can easily do that. So probably we can predict with these oriental trends coming in, and to save the planet, the tendencies will go to a more vegetarian or much less type of meat in the diet, and it'll probably become more international. And that's part of where we might be looking to do some investment as well.
So what does all this mean for investing? It sounds like for the next 3 years, one wants to be virtually in cash and gold.
Yes, absolutely. What we're trying to do now is to protect money. The portfolio we've got a computer model. It already put us heavily into gold, and it probably will increase the holding there. Owning some gilt edge if you're British, or US Treasuries if you're American, is still quite a good idea. The US Fed has made statements very recently, and although we're not strictly linked, many developed Western economies will tend to follow the same sort of doctrine as the Americans. So keeping money available and cheap in terms of the rate of interest is very much part of what governments are doing. Our Chancellor's very much on this case as well. So, and it is entirely possible that the rate of interest on government bonds actually becomes negative. And the reason is that's rather like an insurance policy. If you are in very panicky conditions and you're terrified you're going to lose everything, if the government says to you, I can guarantee that 95% of your wealth, you'll get it back in 2 to 3 years' time, so that you're going to buy this gilt edge stock at 101, and I absolutely guarantee we'll buy it back off you in 3 years at 95. That you've paid a little insurance policy to protect most of your money, and that will become quite an attractive idea. So the idea that we're going to have either nil interest rates or even go negative is perfectly acceptable. And I think that there's a lot of senior economists globally arguing that that's probably what we'll do. And also trying to get out of debt. The debt mountain, which was already truly enormous, has, because of the disease, shot up dramatically. The US Fed is really printing outrageously. But if you leave the printed money just sort of out there, you've devalued it effectively. So the combination of moving away from the petrodollar and also you're printing too many dollars does lead to there will be a massive downtrend in the dollar. And you'll go into other currencies which aren't so dependent on that. And I think a basket of currencies will be the way to go. And within that basket, there's no reason to be especially negative about sterling. I mean, we're part of the basket, and I'm sure we will be. We won't be a huge dominant, but there'll be a player there. So at the moment, there's no reason to be especially negative on sterling.
But it sounds pretty unattractive as an investor that you, at best, don't lose your money, and you're not going to make any capital gain or get very much income.
Income is very, very important. When you look at the large pension plans, either in America or here, the normal numbers on which they have historically worked to fund their pension schemes don't work. Many of the pension plans are already hopelessly underfunded. And on the type of future I'm looking at, certainly for the next 3 years, it's still not going to work. Now, there's only one way around this, and that is the government has to step in and say, we'll just pay you those pensions, and we'll do that out of taxes. So I think this debt mountain and where it leaves us is you're going to have taxes rising. And that's sort of across the board. I don't think we need to get into a debate about whether the rich pay enough or whatever. Basically, you're going to get more government in your face with more taxes to get us out of this hole that we've fallen in, basically. So that the whole world will, to some extent, be more socialist, which may or may not be a good thing, but it's moving that way. And therefore, you mentioned the globalization thing. And I read the book, The Lexus and the Olive Tree, all those ones arguing for that. That's come to an end now. And with some technologies like printing, you can print components off a printing press. That could bring some manufacturing straight back to the Western world. And then you don't need Asian wage rates to do it. So we're in a period of rapid change. And you've got to kill off the old way of doing things before the new good ways can come up. And with all the cycles pointing in this, we cycle people would call it a grand super cycle correction. It's a truism that whenever you've got a system with several lengths of cycle in it, cycles become phase locked. So at some point, it's inevitable the cycles all go down together. And my work had always been illustrating that from roughly now to 2023, 3 or 4 of the big cycles were going to go down together. And in the end, it's been the disease that's finally said, we're doing it now. And up until the disease, it was printing free money or quantitative easing that was trying to delay the break moment. But lots of economists saw this super cycle correction coming. Now we're in it. So we've got to get down to the bottom, get a vaccine, get medicine, get over the disease, and then get out of debt, and then go for the new bull market after that. And that's a long process. And I don't think we can get through that process quickly. I mean, in terms of a vaccine, we don't even have a vaccine for the common cold or ordinary flu. So suddenly expecting one for this disease to pop out of the woodwork in time to make Trump look good for the election, that would be, well, it's never happened before, and I would be inclined to bet very strongly against it. I would think a minimum of a year before we get a proper medicine that's been tested that can go around the world, and even a year is really quite quick. It is entirely possible, according to the science, that we may never have a vaccine for this drug, a disease, because the bacteria evolves. It's already evolved several times. It's a dynamic thing. So we may just have to learn to get used to it and build up herd immunity, which again takes time. Secondly, a second hump in the death rate, I think, is virtually inevitable. And historically, when we look back 100 years to what was then called Spanish flu, the second hump was dramatically bigger than the first hump. And after that, there was a smaller third hump. So I think we're still living with this disease. It's a long way from being over yet. Just because we're coming down after the first hump, don't think it's all over. You should be expecting it to build back up again as people try and get back to normal.
And when you're talking about economic cycles, are we allowed to have a normal economic cycle anymore? It seems as soon as we're heading towards something that might be recessionary, the government just turn on the printing presses.
Well, it is true that quantitative easing certainly has bent out of shape the normal business cycle. Some of the cycles are natural. Our entire life takes place with night and day and spring, summer, autumn, winter. We go round in those cycles, which are natural, and we can't stop that. And some of the other cycles are put in by the way mankind behaves. So they're driven by human beings, and it's the life cycle of different generations. And the normal business cycle, it's called the kitchen wave in the economic textbooks, around about 4 years. The last 3 of those have been stunted dwarfs. They're nearer 3 years long. And that was quantitative easing trying to bend them out of shape. And then the next cycle up is about a decade long. And that one is still pretty much in place, and we're on the down wave of it now. And then there are these longer term cycles, which is too long for us to talk about now. But in our work, we put these cycles into the equation. And some of them are driven by the weather and these sorts of things. But because when several of these long-term cycles get into step with each other, they become phase-locked, and then they're definitely too big for a government to just say, oh, I'm going to ignore that one. I mean, we can all in England remember when an earlier Prime Minister, just after Mr. Blair, suggested we'd seen the end of the stop-go cycle. And fairly quickly after that, nature said, no, we haven't, and we immediately had a downturn again. Some of these cycles are too big to be overridden by human activity.
So really, looking sort of 2 years out, we want to be starting to look to invest in certainly China and thereafter India. But the thought of investing in China fills me with horror, because it's not been a terribly auspicious place for Chinese listed companies in the UK, certainly. How do you suggest people get exposure to these markets?
Well, it's a very good point. So in the newsletter that I write, we deliberately are using exchange-traded funds. So instead of paying up a premium for some glamorous individual fund manager who may stop being glamorous just after we've backed him, you simply buy an exchange-traded fund that backs the market. So when I was investing in India, I bought an exchange-traded fund that backed the Sensex index. And here in FTSE, you could have an ETF that backed FTSE, or in America, you could have one backing either the S&P 500, or if you really wanted a more swinging ride, you'd go for the NASDAQ one. So an exchange-traded fund takes away the glamour of having brilliant individual fund managers. It is true that in any period, especially with smaller companies, there will be each year a glamorous person who picked 1 or 2 or 3 super duper little companies that went up 1,000%, and he's the top picker. But as many people have found out the hard way, then you back his new fund, and it goes straight the other way again. And even some of the really top hedge fund managers, they have a purple patch. They win for maybe several years running and then lose money. If we go right back earlier in time, managing the biggest fund at Fidelity for a long time, Peter Lynch, who wrote a book, Run Up on Wall Street, he told me years ago that in the period, he beat Wall Street for 13 years with an awful lot of money. Many of his own unit holders lost money in that period because they traded him. They waited for his unit price to go up and then they bought. Then when it fell back a bit, they sold, and their own activity took them to the cleaners. So we can avoid all of that by using exchange-traded funds. That would be the safe way to do it.
We've got a question from Richard Straffon, who says, thank you for your time, Robin. You mentioned that in your portfolio you had 25% in gold, etc. Would you mind giving us a sense of what the other 75% is at the moment, and any likely big changes in the near future?
Yes. The other one, the next bit is gilts, and there is some equities in there, but it's not. Normally, when we put in the exchange traded fund to represent equities, we have a FTSE one, a S&P one, etc. But a couple of years ago, Morgan Stanley were the first to do it. They created an index that was not limited to a particular country, but to some particular statistics. They were called high quality equities. And the number of boxes that the company has to pass to be on the list of high quality is very difficult. So they're famous international businesses. Some are American, some are British, some are Chinese, some are Indian, that they've got money. They've had audited accounts. They've never cut the dividend. They've never lowered the earnings. By the time you get people that tick all those boxes, you get an index of very high quality international stocks. And that is in the top grouping of our model. So, and it's deliberately defensive equities. We're not trying to make more than anyone else. We're trying to have some equity exposure and get some dividends without taking too much risk. Now, of the other things that have risen up, the rally in the American market has been stronger than others. I've told you why I don't want to buy it, but it's just better than British cash. But if the market rally is now over and coming down, it will rapidly become less good than British cash. So at the moment, cash is not quite in the top group, but it's very close. So what my model is saying to you, if you just sit on plenty of cash, you're not going to be punished for doing that. And then when you get a real bargain offered to you, you will have the money to buy it. So it's a way of keeping options open without getting punished. So do plenty of that. So we've got a gold at the top. And incidentally, it's not commodities. There are no other commodities up there at the top. Most other commodities are negative. So it's just gold, then gilts, then these global quality equities, and then cash would be fine.
And Bernard O'Sullivan asks, and I think the question's still relevant, why hold gilts? He also says cash, but you've just covered that off. Why hold gilts in the short to medium rather than gold?
If we go forward into a period of negative interest rates, you're going to make a capital gain. As the yield goes down, the capital, it won't go up a lot, but it'll go up a bit, underwritten by your government. And that would apply to US treasuries, or it has to be the top government bonds of major economies that you can do. So normally a government bond would be paid back at par. But if they announce we're going to pay you back at 95 and you bought it at 101, your price of your bond goes up now, basically.
Robin Maxwell, I'd be interested in Robin's view on Brexit, with or without a deal in 2021, and impact on sterling and the economy.
Yeah. Okay. As it happens in the list of investments that I've got, the UK market itself is quite low on the list. So on my work, at the moment, we don't own any UK equities. But so talking about Brexit, I mean, we are committed to negotiating a deal. I know at the time of the disease is so much the front on the active burner that it doesn't look as though any progress is being made behind the scenes. But I'm sure that there is progress being made. And I don't think we're going to be as negative and ignore Mr. Barnier as many people think. I think that we're going to have a Brexit. It is a top priority. The country, after the interval, has finally decided, yes, we want that. And as soon as the disease is more under control, we're going to be building up the infrastructure in England to link the north and the south properly, which is, I'm sure the government is committed to that. So the exact details of Brexit, the disease in a funny way is changing that, because we've suddenly had a period when you're not doing much trading and you're realizing, well, that didn't matter at all. A lot of people have realized I didn't go to the office. I can do it perfectly all right from home. Well, the same will apply to things we buy or don't buy from Europe, or they buy from us. So I think that will affect the negotiations. But I think we're going to get out with a deal and then just carry on as neighbours to Europe.
Another question here. Robin mentioned an economic recovery from 2023 driven by millennials. But how would that happen with millennials earning lower wages and significantly lower returns that baby boomers as QE has front-loaded returns? Will it be a multi-decade malaise rather than a new economic cycle? As millennials, I'm inclined to disagree with Robin on this point.
Yeah, no, I agree that they're, bearing when I have 4 children myself who fall into some of these brackets, they're covered in debt, and so I agree with the negativity, and also with the valuation that we've got on certainly American equities and to some extent ours. The prognostication of rapid growth is not good. But what I'm suggesting is we're going to go down to a lower low, and it's coming up from that lower low was very good. Now, what happened when we go back into the 30s? Once we got down to the 1933 sort of low, we then started to come up very strongly. Of course, it took 10 more years to get back to anywhere near the high. But the fact is, if you got in at the bottom, you then enjoyed lots of growth. So I agree that it will take at least 10 years to get back up to the top. But if you're buying at the lowest low, that period will still be great. And it won't be the generation, I'm a baby boomer, so the next generation is too small. It won't be their generation. It has to, the earliest generation that can participate in this growth is the millennials. The second thing is, although many of them are in debt now, some of that debt will be forgiven by the old man or the grandfather dies and says, well, I had a house, you can have that. Or I even had 2 houses, you can have some of that. So they're going to inherit some money, which will to some extent wipe out a lot of the debt. And then the new technologies, when they come in, I mean, most people now have very large flat panel TV screens. There was nothing wrong with the old TVs we used to watch, but when the new technology comes in, you think, you know what, I'm going to have it, bang. And so with the new technologies that'll be around then, it'll be irresistible to some of them. I mean, look at people, they go into debt with them, they live on their cell phones. My generation of people don't live on the cell phone. I regard it as an evil, complicated thing. I can't work it properly. But the millennials will grow up with all this technology. And they'll have a different lifestyle. So I don't know that it'll be a boom, but it will be a new period of growth. And I think the best bit of the growth will be in places like Asia and possibly bits Africa as well. Although on my work, Africa comes after Asia in terms of the rate of growth.
And we've got 2 questions regarding gold. John Wright asks, what's the best way to invest in gold? And there's a second question by Jamie Streeter. Any thoughts on gold miners versus physical gold?
Yes. In the model, we only put gold, a bullion. So it's an exchange-traded fund but there is real gold backing that. In some exchange-traded funds, you've got a contract with somebody, and if he's bust when he owes you the money, you're not going to gain anything. So, particularly in the case of gold, you need to make sure that the ETF that you're going to own really is backed by real gold. When you get away from America, the story is that. But when you're in America, they all know that back in the old days, gold was confiscated, and they fear that will happen again. And it might. So they want to own gold in real coins stuffed into a sack in a place that they've hidden away secretly. This is a sort of neurosis, but it's very powerful. And I think particularly in America, it definitely applies. I also think that high quality gold mines are perfectly acceptable. So your Newmont and your Barricks, Agnico Eagle, all of these ones are top ones. And then what tends to happen is, firstly, the price of gold goes up. Then the price of the largest, highest quality gold mines goes up. And then lastly, there'll be a hole in the north of Canada with a liar stood at the top of it, and that one will go to the top. And when you finally get to the bottom of that hole and realize there's nothing there, the cycle is over and goes back to base again. So we're so early in the cycle, though, that I think at the moment just owning gold itself is fine, or the biggest blue chip gold mines that you can get. The trouble with an individual mine is, you got the story right, and then you bought a particular company, and then they had a waterfall or a mine collapse. So you lose money when the whole gold story still goes ahead. If you've at least got bullion, you avoid all of that, basically.
And James Giro says, why not silver whilst it's at an all-time high ratio against gold, only twice
absolutely.
seen?
And one of my favorite individual stock punts, and I've won competitions with this, is Silver Wheaton, which is a wonderful situation. It is true. If we were at the moment in a commodity boom, I would be all over silver and having silver. And there are some companies that give you a bit of gold and a bit of silver. But at the moment on our work, the model is saying this is not yet a commodity boom. Most commodities are weak. The price of oil is exceptionally weak. The price of coal is weak. And it is just gold being treated as money with a big Asian influence. Incidentally, China is now the biggest supplier and owner of gold. It's overtaken the West. We're talking about gold as money. And if we later get to be a commodity boom, well, then the silver will take off and fly again.
And David Peter asks, if you believe the market is going to fall, which instruments would you use to go short?
Well, again, in our list, most indices, there will be an inverse equity one. Just at the moment, there was a period in the crash period when inverse FTSE equities were strongly recommended. And I think we had it for about a month, 2 months. And then the rally dropped it down the list a bit. So if we go back into a rapid fall, there will inverse equities as a position, which is an ETF that does the opposite of the index, will come back onto the list. I think what happens, though, is you get two types of investor. There are those that want to make money, and they will go for the inverse equities. And the others are just trying not to lose money, and they probably won't do that. They'll be buying positive things to cushion the blow. At the moment, it's saying don't yet go for inverse equities again. But if today's fall develops a little bit and the index drops back below the 200-day line, I think you'll find inverse equities comes up. And that's the neatest, easiest, lowest cost way of doing a put.
And Bill Hall asks, how do rising global political tensions fit into your long-term investment thinking? Whilst people question the future of the EU, could you ever see the same sort of political concerns being raised about the stability of the US as a single country?
Yes, yes is the answer. Funny enough, this was all written up a long time ago by a man called Mackinder. He actually published a map of how the world will eventually break down. And so far, history is unfolding to support his contention. Basically, America is joined up to Canada and South America. And within that era, even when the dollar stops being globally dominant, I think in that bracket, the US dollar will still be very, very important currency. It may be the dominant currency. But when you come over to where we live, Asia and Europe are joined up together as Eurasia. Mackinder called it Eurasia. And the Mr. Xi's super highway that he's building across with railways and airlines comes all the way across the continent, going over the top of 63 other countries, and they get to Europe. So Eurasia will develop as one, and probably Russia, which is along the north edge of all of that, trades into that environment. So Russia, which is trying to sell energy and all of that, will be participating in the growth of Eurasia. Now, clearly, Eurasia, with or without Russia, is bigger than the Americas, and it's a separate group. That would be the group probably dominated either by a basket of currencies or more dominated by the Chinese currency. And then there are some other places which, for old loyalties, will be linked up. So Australia down where it is, and New Zealand, well, maybe they think they're more Eurasian than American, or, that would be a political decision rather than a geographic decision. So basically, I think the growth of Asia is going to be dramatic, so that Eurasia, growing faster in the Asian bit than the Euro bit, will become a sort of super continent, and then the Americas and Canada stay where they are, basically.
Tremendous. That's all we've got time for, but there are a few questions saying, where can people find you and how do they find out more about your newsletter? So perhaps you could tell us that.
Yeah, okay. The company that publishes is called South Bank Research, and they publish lots of newsletters, and my one is called DITA, Dynamic Investment Trend Alert. And I do it jointly with a colleague called Rashpal Sohan, who's very highly qualified Indian actuary with 2 degrees. And so all of our computing is done by him. And it's published at South Bank Research. It's not cheap. It's £1,400 a year. And if you were trying to follow its advice with less than £50,000, it's probably not right. But anything more than that is right up your street.
Fantastic, Robin. Many thanks indeed.
Pleasure.
If you want an email notification of webinars or events PIWorld are organising, please sign up for events on the right-hand side of the homepage at piworld.co.uk. There are 2 boxes. The top, sign up for a notification of a new video as it's published, and underneath, sign up for events. Different lists, no spam. And please do tell your investing friends about PIWorld and write comments or like our videos on Twitter, bulletin boards or YouTube. We'd like to go on providing these free webinars, and getting really good speakers like Robin relies on you and the audience numbers we attract. You can find me on Twitter at TamsinPIWorld. Many thanks to you all for joining us, and stay well. Goodbye for now.